Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi Singh. Earlier this month, we released our second half 2023 India Market Outlook titled Keep Calm and Carry On. In today's podcast, we summarize our views on FX and commodities. After remaining under pressure for most part in 2022, the Indian rupee or INR has been relatively stable since Q4 of 2022. We expect the INR to be range-bound over a 12-month horizon as it is likely to remain supported by a number of macroeconomic factors that include above trend and ahead of peers' economic growth, improving real yields, better balance of payments, lower commodity prices, improving foreign investor inflows, strong RBI forex reserves, and a bearish USD outlook. However, falling export growth amid weak global growth outlook, narrowing policy rate differential with the US are likely to pressurize the INR. Coming to the US dollar, we expect the USD to be range-bound over the next 3 months before resuming its decline on a 12-month horizon. The Fed's recent guidance towards a higher terminal Fed funds rate due to a resilient labor market and sticky inflation will likely keep the 2-year US government bond yields elevated. This means the US dollar will remain range-bound over the next 3 months owing to the interest rate advantage over other major currencies. Additionally, the decline in US and global liquidity due to a combination of ongoing reduction in central bank balance sheets and the US Treasury refilling cash reserves is also supportive for the US dollar. However, we still see a likelihood of US recession over the next 12 months. Hence, we expect the Fed to start cutting interest rates sooner than its current guidance. As markets price Fed rate cuts in advance, we expect the 2-year and 10-year US government bond yields to decline substantially over the next 12 months, leading to a narrow interest rate differential and pushing the USD lower. Persistent US inflation or a sharper than expected US growth slowdown are key risks to a bearish USD view, as they may spark safe haven demand leading to USD resilience or even USD strength. Coming to gold, we are neutral on gold versus other major asset classes with a 12-month forecast of USD 2050 per ounce. Upward revisions to our forecast of 10-year US bond yields and the US dollar, which are negatively correlated to gold, lead us to see smaller upside for gold from here. Furthermore, hedging demand is likely to be lower with the suspension of the US debt ceiling. With that said, we still see a place for the yellow metal as a portfolio ballast within a diversified allocation. Gold has historically outperformed in recessions, and it has displayed safe haven properties during times of crisis. These features include the appeal of gold as a hedge against a backdrop of elevated macro uncertainty, especially with the current low investor allocation. Continued demand from central banks, households, and investors are other key drivers behind our constructive view. Coming to crude oil, we stay bearish on oil as recession risks remain elevated on the back of tight central bank policies. On a 12-month horizon, we expect WTI oil to trend lower towards USD 65 per British barrel on the following factors. First, weaker oil demand and depressed positioning from a slowing global economy. Second, resilience of Russia's exports amid direction of flows. And third, buildup of inventories from supply beats. The muted performance, despite Saudi Arabia's voluntary cut of 1 million barrels per day, suggests that in the absence of a big cut, further OPEC Plus interventions are unlikely to offset the demand-led downward price pressures. In the next 1 to 3 months though, WTI oil price is likely to be well supported around $71 per barrel on the back of stronger demand from China. That's it in this edition of the podcast. Do reach out to your relationship manager for a copy of our market outlook. And thank you as always for listening. If you enjoyed this podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.